You didn't start your business to lose money, but growing doesn't automatically mean that you make more of it. Costs creep in, a few pricing decisions pile up, and your margins start slipping without any one obvious cause. When that happens, it's easy to start swinging at the wrong problem, cutting a cost over here when the real issue is over there. The way out of that is learning to actually read your income statement. Done right, it doesn't only tell you whether you made money, it tells you why. So let's walk through it. What profit and loss management really is, how to read an income statement line by line, and the mistakes that catch people out. Profit and loss management, or P&L, is just the ongoing habit of watching, analyzing, and improving your income statement. Your income statement is the report that shows whether your business is actually making money. The way I think about it is like a report card for your business. Revenue sits at the top, you subtract your costs as you move down the page, and what's left at the bottom is your profit or your loss. But like a report card, the final grade isn't really the useful part. What's useful is understanding why you got it. If you bombed in one subject, you know where to focus. A P&L works the same way. A weak result should point you to a specific part of your business that needs attention. Let's walk through an income statement, because once you know what each line means, the whole thing gets a lot less intimidating. There are really 7 pieces. The very top is your gross revenue, which is all the money coming in from your business before anything's taken out. Right under that is the cost of goods sold, usually shortened to COGS. These are the direct costs of making whatever you sell, the materials and the labor that go straight into the product or your service. Subtract COGS from your revenue and you get gross profit. That's your profit before any of the overhead, and it tells you whether the core thing you sell makes money in the first place. Then come the operating expenses, which is your overhead, rent, salaries, marketing, utilities, the cost of just running the place. Take those out of gross profit and you land on operating income, which you'll also see written as EBIT, short for earnings before interest and taxes. It's a good measure of how the business itself is doing, setting the finances and taxes aside. Below that are your non-operating expenses, things like interest on loans and taxes. Once all of that's accounted for, you reach net income. It's the bottom line, your actual profit or your loss. Now, the reason it's worth knowing all 7 is the way that they react to each other. More revenue doesn't automatically mean more profit. If your costs climb at the same rate, you've grown the top line and netted nothing. But if you can lift your gross profit by nudging prices up or getting your direct costs down, more of every extra dollar makes its way to net income. Seeing how one line moves another is the whole point of reading it this way. So why does this matter so much, especially if you're a smaller business? Mostly because small businesses have simpler income statements, fewer revenue streams, fewer cost categories, and that makes the P&L easier to follow. But it also means small changes hit harder. You don't have a dozen other income streams to cushion you. So one slow month, one lost client, or one surprise cost can move your profitability big time. Looking at your P&L regularly is how you catch issues while there's still time to do something about them. When you use an income statement consistently, a few things start to happen. Your spending lines up with your actual priorities, because if you say you're chasing growth, but your overhead's rising with no extra revenue, the statement makes that obvious. Your budgeting gets more realistic because you're planning off how the business actually performs instead of just guessing. And you spot risk earlier because most money problems build slowly. A little margin compression here, some expense creep there, and regular review is what catches them before they turn into a cash flow problem. All right, so what do you actually do with all this information? You don't need perfect systems on day one. For most businesses, P&L management gets a little better over time, but there are some moves that matter. First, look at your margins at the product, service, or customer level, not just in total. Your overall margin can look fine, while it's hiding a couple of products that lose money or a couple of people that carry everything. Break it apart and see if you can find which is which, and then put your effort where it actually pays off. Second, separate your fixed costs from your variable ones. Fixed costs like rent, insurance, base payroll, they stay roughly the same no matter how much you sell. Variable costs like your materials, your shipping, your commissions, they move up and down with sales. If your losses are coming from fixed costs, cutting them helps more than selling more, since more sales might just pile on more variable cost. Third, watch your margins. Gross profit margin tells you whether your pricing and your direct costs are in balance. This is also where you'll run into the term EBITDA, earnings before interest, taxes, depreciation, and amortization. In plain terms, EBITDA strips out financing and some accounting noise to show you how well the core operations of your business turn sales into profit. Watching both your gross margin and your operating profitability tells you whether pressure is coming from your direct costs, your overhead, or just inefficiencies. Fourth, compare what actually happened against what you budgeted. That gap is called variance, and it's where a lot of useful questions live. If you spent more than you planned or brought in less, the budget comparison is what surfaces it so you can figure out why. And underneath all of that, keep your accounting consistent. Pick a method and stick with it, whether that's cash accounting, where you record money when it actually moves, or accrual, where you record it when it's earned or owed. Categorize things the same way every period too. Before we finish up, let me run through the mistakes I see most, because most of them are easy to avoid once you've seen them. The big one is confusing your cash flow with your profit. You can be profitable on paper and still not have the cash to pay your bills. It happens when you've booked revenue and you haven't collected it yet, or a big upfront expense drains your reserves. On paper, you look great. In your bank account, you're stretched thin. Second is ignoring the non-operating stuff. If you only look at operating performance, you can miss interest, taxes, and one-off charges that still hit your bottom line. Skip those and you'll think you have more room to spend or invest than you really do, which can land you in trouble. Third is not capturing all your costs. If expenses slip through without getting tracked or getting dumped into one big generic pile, your margins are basically fiction. You can't manage what you can't see. And fourth is reviewing too rarely. If you only look at your P&L once a quarter or even once a year, you're finding problems long after the point of where there's been a cheap fix. Reviewing monthly is a good habit for most businesses. Fifth is making decisions on incomplete data. If you don't have your revenue broken out, your expenses properly categorized, and some history to compare against, it's easy to cut the wrong cost or read a short-term blip as a big trend. All of this gets easier when your financial data is accurate and current. That's really where Slash fits in. The hard part of P&L management usually isn't the analysis, it's actually just getting clean, timely numbers. Slash is a business banking platform that pulls your bank accounts, corporate cards, and incoming payments into one view. So all of your spending is connected to your bottom line instead of scattered across a dozen places. Actions get categorized automatically, and you can set rules so those categories match how your business is actually organized. Keeps you from dumping everything into one vague operating expense bucket. From there, a few things help directly with what we talked about. You can get real-time cash flow analytics, so you can see which activities are actually driving profit and where a good change would do the most good. Card level controls let you tighten spending in your lower margin areas or open it up for spending that you want to make. An income statement is one of the most useful tools a business owner can have, but it's only useful if you know how to read it and act on what it's telling you. If keeping the underlying numbers clean is the part that's been slowing you down though, check out Slash today. Thanks for watching. If you want to try Slash, the link is in the description. And if you found this helpful, hit like and subscribe. We publish guides like this every week on running a smarter, more modern business. To see more of my content, read our blog at slash.com/blog, where I've written over 100 articles to help business owners better manage their money. See you in the next one.